Good morning, everybody. Thank you for coming. I'm Barry Starr. I'm the CEO of Wall Street Horizon, and it's wonderful to see all of you here today. We've got a great program set up for you. For those of you who don't know, Wall Street Horizon is the gold standard for curating extremely accurate, forward-looking corporate events data so you can make and not lose money. We support institutional clients with an edge for your investing and trading needs, and we appreciate your being here with us today. This is now our fourth Data Minds event, which we're happy to host to help you gain access to some of the best independent minds in the field. So listen today, sign up for a one-on-one, and talk to anyone here to make an introduction or get your specific questions answered. Now, on to our program. Let me introduce you to our moderator for the session, Christine Short. Christine is our VP of Research, coming to us from Estimize, and before that, both S&P and Thomson Reuters. With over 15 years in the financial data industry, her research has been regularly featured in financial news outlets such as NBC and Fox to talk about corporate earnings, the economy, and of course, corporate events. I hope you will learn as much as I hope to. Christine, the Zoom floor is yours.
Thank you, Barry, and good morning. Welcome everyone to Data Minds. As Barry mentioned, we have an all-star panel that you can see here with us today. We're going to cover a range of topics, mostly around the alternative data landscape and then certain trends that our panelists are seeing for the second half of the year. Those of you that are joining us, we will be saving Q&A until the end. You can see at the bottom here, you have the option to just type in a question. So know that if you do ask a question, we'll be saving that for the last 10-15 minutes of the session. But without further ado, I'd like to go ahead and introduce our panel. Joining us today in no particular order, we have Olga Kane. She is a managing director at Synthesis, focusing on statistical arbitrage in equity markets. She has over 15 years of experience where she held senior roles in both buy-side and sell-side and developed her professional expertise on the intersection of traditional fundamental asset management and cutting-edge technologies transforming the industry. Also joining us today, we have Nick Kolas. He has over 30 years of experience in the industry and is a recognized Wall Street veteran, specializing in equity research, investment banking, and money management. He appears regularly on CNBC and Bloomberg and is widely quoted in the financial press. Many of you may recognize him. Chris Petrescu, founder of CP Capital, which endeavors to bring data strategy as a service to the financial world. Chris was previously head of data strategy at Exodus Point Capital Management, where he managed global data sourcing and strategic enterprise data efforts for both quantitative and discretionary teams across all asset classes. Chris was also a data strategist at WorldQuant and is a frequent speaker at industry events like this one. Sean Feeney leads the product strategy team for NASDAQ's U.S. options business and manages the day-to-day business operations of NASDAQ's 6 U.S. options venues. With 22 years of experience in the options industry and trading product development in the exchange space, Sean's focus is on the market structure and technical microstructure surrounding high-frequency trading in U.S. options. And last but not least, we have Matt Eckroth joining us from London as a former systematic portfolio manager and strategist with nearly 20 years of experience at investment banks and hedge funds, including Goldman Sachs, Lehman Brothers, and Engineers Gate. Over the past 4 years, he headed data strategy efforts at Sentient Investment Management and Morgan Stanley. So welcome everyone, and as Barry said, we really appreciate having you all here. I think our participants are going to get a lot of value out of hearing from so many different perspectives. We've kind of got everyone here covers something different. So as you heard, great resume from all of our participants here. So I'm going to kick it off a little by chatting about the current alternative data landscape. Over the last decade and really the last year, data information has become even more as market participants are looking for some sort of consistent returns in a global market that's been marked by volatility. And at the same time, the alternative data space has just swelled and gotten more and more overwhelming. So it's harder for data users to leverage that data efficiently. I'm going to start with Chris, just because we covered something sort of similar in the last Data Minds. The question on that session was more around how do you find and source new and valid sources of data. This is more around how do you tell your clients to optimize their data ecosystem with the right mix of data vendors to match their firm's needs.
Sure. Thanks, Christine, and thanks for the introduction. Nice to be here today. I think the real thing that I stress with my clients, and I've lived this at some of my prior firms, and one of my prior firms in particular, is crawl before you walk, before you run. It sounds very simple, but if you're starting up a data effort, I've had clients ask me, hey, what can you get me on this certain ticker? It's Monday, the earnings are on Thursday. What can you get us? We just found you on LinkedIn, and I just caution them that doesn't work that way. There's no secret sauce, there's no shortcuts, there's no magic bullets. There's things that you can buy to speed up and optimize how you onboard data. You can work with people like myself, not to talk my book, to help source data and recommend certain data sets and run the data pipeline. But these things take time and they take budget, right? So in the case of how to set up an ecosystem, if you're going to a battlefin.com or any of these aggregators, you'll be inundated with thousands of data vendors. Some of them have value, some of them don't. Some of them are getting acquired, which we'll talk about later. Some of them are just starting up, which we'll also talk about later. So it's important to just really have a laser focus on what type of strategy, where do you want to compete? How do you want to compete? Do you want to compete on speed? Do you want to compete on maybe a longer term signal? Do you want to compete in certain markets? And then lastly, the types of data that you onboard. I always say stick to basic foundational data first. You need, not to talk up Wall Street Horizon, but you need a really solid data set that tells you when corporate events are happening. If you don't have that, you're essentially blind to the largest volatility spikes essentially in any market, right? It's pretty much earnings and news, and earnings estimates, revisions, and news, fundamentals, things like that. Start with a base, and then you can add on, maybe if you have some areas of expertise around consumer transactions or consumer discretionary data sets, you can start to layer those data sets on top of it. But you really need a pipeline, and I preach almost religious discipline to have certain data sets that you can build off of others, and don't just go out and blitz the market and bet it all sort of on that first trade. And that's really the way to optimize, to give yourself the highest chance of success.
Yeah, I think that's a great point, to start with the core data sets. And I know users can get interested in some of these alternative data sets they don't quite understand yet, but taking the time to build that core base before you layer on, like you said, some of those newer alternative data sets. Matt, I wanted to ask you the same thing. Chris brings up the point about you can go to a Battlefin, you can go to one of these kind of data warehouses and sort of get overwhelmed by all of the different types of data. Some will have value, others won't. How do you advise your clients not only how to build out their data ecosystem, but how do they not waste time testing data that might not bring them any value?
Yeah, no, that's a great question. And firstly, thanks very much for the invitation to join the panel today. Very excited to be here. And I can only echo Chris's comments. Walk before you can run. The clients that I speak with, I stress, as Chris does, the importance of building a solid foundation of some core data sets. Wall Street Horizon is certainly one of the data sets that I've used extensively in the past as a portfolio manager. I think forms a key part of that core data set package. But there's core data sets that you need to put in place first, and then you can start to explore alternative data that will meet your particular investment needs. And it really is a question of, what are you doing as a manager? Are you a high frequency manager? Are you a high medium frequency manager? Are you a very long-term manager? And then the core data sets really will be driven by your individual process and your holding period. But I think what has been exciting over the past couple of years, certainly since COVID has hit, we've had, on the one hand, I would argue we've had a significant change of market regime. On the other side, we've had the growth of many interesting alternative data sets that can help investors really make some more sense out of what is happening. Because I would argue that the regime that we're in now is nothing like any investor in the markets today has ever seen. And I think that requires a new mindset in how we as investors should approach the market. Does that mean we need higher frequency data? In many cases, it does. If you go back 5 or 10 years, quarterly data, annual data, in many cases was fine. That's not the case anymore. Doesn't mean you need to be ultra low latency or super fast. But I think recognizing that price discovery now is accelerating, and what are the data sets that can help that? And it really depends entirely on as I mentioned, on the frequency of your strategies and on the industries in which you focus.
Yeah, it's a great point. It's an exciting time for data. It's just become more overwhelming, right? Because there is so much out there, and it's just about figuring out how to use it efficiently. And Nick, I wanted to get your comments here. Someone who's worked as a PM, a chief market strategist, now you run a research company. What's your approach been to working with data? I know you use a lot of free and public sources of data.
Yeah, and let me add my thanks to you and the team for inviting me on this meeting. It's awesome to see everybody. You know, our product is a newsletter, and we have a data section every day. And the idea is to really give clients, and they span the range from family offices to RIAs, everybody, really, even high net worth individuals, to have them understand and respect the importance of always having a data component to any investment process. And implicit in that is always stress testing current market narratives with freely available data. There's really no excuse not to use data in every single investment decision and in every thesis that you're developing. So for example, we recently did a quick piece looking at Google Trends, which is simply the number of times a word gets Googled. And we looked at COVID in the US versus COVID globally, and it's dramatically different. In the US, COVID searches are 65% below the highs of last year. In the rest of the world, they're only 30% below and still rising. So it just gives you a basic sense of what's the US consumer thinking about versus the rest of the world. That's important if you're allocating capital between US and non-US equities. We also use things like Apple Mobility and TomTom data that shows you daily traffic trends all around the world. So if you're thinking about how is the world recovering from the pandemic, that's important information to have. We also use things like air quality data, again, all freely available. China is the one place where it's been harder and harder to get an edge because they're shutting down data sources. So TomTom used to publish daily traffic data for every major Chinese city. They shut that down 2 months ago. So we've reverted to looking at air quality data to get a sense of how does that look like versus 2019 to give us a sense of the recovery in China. So what we try to get across to people is no matter what you're thinking about, no matter what theme you're thinking about, there is a data angle to it, and you have to incorporate that into your process.
Yeah, and I've read a lot of your Google search. I read the COVID one you recently put out, and I am an avid Data Trek morning briefing reader. So anyone that's not on that should take a look into it. It's chock full of information. In sort of the same vein, and Chris kind of teased it already, wanted to switch now and talk a little bit about the consolidation happening in the alternative data space, whether it's small alternative data is merging or private equity acquiring either data analytics or small data companies, even the big data providers acquiring many smaller data companies just so that they kind of have a hold on the information that we all need to make important investment decisions. And my question, I'm going to start with Sean, is what do you think this consolidation of the space means for the industry as a whole? What does it mean for data buyers? You're at NASDAQ. They've been making some pretty significant data acquisitions recently. Do you think it's going to make it easier for data buyers?
Yeah, I think there are actually two ways to look at it. And you can certainly look at it as larger corporations and some of the larger private equity firms looking to control the data that's being at least distributed to the end user. And then you could also look at it as from an access perspective. NASDAQ purchased an alternative data source. We had the analytics hub internal to NASDAQ, which was more proprietary data, and then we would bring in other firms to bring different elements of data to that platform. Then we made a strategic purchase of a Canadian firm called Quandl, which is more of an established alternative data company, and then we merged those two. And we really did that to provide more of an access point, a centralized access point for users to come in, source additional data, and then for other data providers to be able to link up to that network for, if they had a distribution issue, if they had trouble reaching consumers en masse, right? So we can look at it from both sides of the coin. We tend to look at it from the distribution perspective and being able to access that data and a different suite. And perhaps at NASDAQ, if somebody were to come to us, they wouldn't even know that a certain data stream existed. And then we'd be able to distribute that to them appropriately. And
Yeah,
also, thank you very much for inviting me to the panel. I don't want to go without thanks, but thank you very much for having me. It's an honor and a privilege.
Of course. I mean, you bring up a good point about access, and that's something that has been kind of top of mind in the industry about democratizing information and making it available to more and more people. Olga, as a quant, you use many of these data sets, you test them. How do you see the consolidation of the space either affecting your work or the industry as a whole?
From the data buyer perspective, I guess it's less interesting to have like access to the marketplace, and it's much more interesting to look at it as a more integrated data set. So what I mean by that is when a larger data vendor acquires smaller data vendors, that larger data vendor, they normally have not only platforms for alternative data, but also traditional data, and their mapping identifier. And so that data set becomes more standardized in terms of quality. And a lot of times it becomes more integrated in their ecosystem, token mapping, or maybe like some overlap with their other data sets. That is something that works really well for us, especially for quants. Now, another implication that I see is that, which may not necessarily be a good thing, but it gets a little bit harder to negotiate pricing with a larger vendor. And sometimes it's get a little bit harder to get a more customized, a better client service, only because you become like a smaller client or one of many clients, as opposed to working with a smaller vendor. And another thing that I wanted to bring up, which I think is a little bit, it's not necessarily that obvious, but I think it's still from the marketplace perspective, it's important. So with this consolidation trend, new players in the industry, or people who like data owners who are thinking about becoming data vendors and thinking about selling data to financial institutions, they see a clear exit strategy for their businesses. And so with that clear path to acquisition, to selling their business to a larger player, they might be less hesitant to come to this market and start selling data, which for me as a data buyer is also a good development.
Yeah, and we'll TBD see what happens. There's a lot of rumors out there floating about some of the bigger players and who they might merge or acquire. I just wanted, the last topic we're going to cover is, we're at the second half of the year now. Wanted to talk data trends either by sector, if that's something you cover. So Chris earlier mentioned, if you're someone that covers consumer discretionary, do you need customer transactions? And, what sector trends you see developing in the second half of the year, and what data users will need to understand that industry, or just generally what market trends are you seeing develop, through the second half of the year, and what investors need to be aware of. So we're going to kind of do a round robin here and get everyone's take. Chris, if you want to start us off.
Sure. I mean, I think, one thing, transaction data is one of those things that's become completely table stakes, even for quants. I mean, discretionary investors were using it for a long time. Quants were starting to use it over the last 3-4 years, but I think the issue is those names have huge liquidity. They have huge volatility. That yields itself to quant strategies from a 30,000-foot view. So these data sets are table stakes, the same way that events data, I would argue, has become table stakes these days. So, and transactions data, it's not just who's buying at Starbucks. You've got travel in there, so you can see who's booking flights to where, who's booking hotels, who's booking rental cars, who's booking cruises, or maybe in this case, who's canceling cruises. So the transaction data space used to cover 100 tickers if you were lucky. Now it covers 300, 400, 500 tickers in the US. And now it covers that much over in Europe as well. So that has continued to develop for me. I know it's been around for a while, but it's been something that I've seen that the true leaders in that industry have just really pulled way away from the pack. I'm not going to, don't have to name any names, but there's 3 or 4 firms who I'm huge fans of. And then there's just a long tail of other providers in that industry. So, and there hasn't been any consolidation per se. It's just these players have just really kind of elbowed out the competition and increased the quality of their products, especially during COVID. I think that data became even more useful because people were using it a little bit more broad strokes. The same with location. It was less obsessing about, same store sales growth, and it was more about identifying the trends. So you'll see companies like, Wayfair is selling furniture. The company goes up 1,000%. Transaction data would have told you that months ago. You would have seen this trend. People were searching for outdoor furniture or searching for home office equipment, things like that. So yeah, transactions for me is still a leader in the space. And one thing I would go back to in terms of the acquisition space is I'd like to see an acquisition of a Battlefin type of firm by perhaps an exchange or another larger data provider, because to get back what we were saying before, these firms, they've democratized the information. That's really the purpose of this call. There's so many companies out there. How do I find all of them? How do I search for all of them? That's step one. 5, 6 years ago, that didn't exist. You had no marketplace. You had no yellow pages of data or catalog or anything like that. Now that it's all out there, the second derivative of this call is how do we use it efficiently? And that's what we were getting into. Start to cherry pick best in breed data sets. You're not just trialing this data from A to Z, and pick what you're best at. And also lastly, I'll say is that there's certain data that works in certain markets and works less better in other regimes. So travel data and transaction data might be really, really powerful for the next 6 to 12 months. And then after that, it might transition away to just a more normalized data set, and you can get back into other sectors like energy or looking overseas and things like that.
Yeah, thank you, Chris. Olga, what are you looking at?
In terms of we don't really focus on specific sectors in our trading, but in terms of data categories, I see much more interest in trading flow, especially retail trading flow. Like last year was about whether or not retail traders can move the market. This year, we know they can, and the question is what do we do about it? So that becomes a little bit more popular. In terms of the general market trends, what I've noticed is that the marketplace is becoming more transparent. So we used to be like very hesitant. I mean, like all market participants, especially data users, we used to be very hesitant to disclose like what do we use, who we work with. Now it's a little bit more transparent. And with that, when I speak to a new data vendor, I can say, okay, I see what your data set is about. How about this, that, and company A, B, and C that are your direct competitors, how your product is different. And now we're talking about, depending on the type of a data set, let's say it's a credit card data. Now the biggest issue is time lag between when data becomes available and becomes available to clients, right? And now the data vendor gets to explain how their product is better than the next guy's product, which I think it's a new development. It hasn't been the case. So I guess with that, the quality of data and the transparency of the marketplace itself becomes more established and more transparent.
Nick, what's on your radar?
Yeah, two things. The first is inflation and measuring how the consumer is responding to inflation. So we do a regular search across 30 or 40 different Google Trend search terms for things that relate to consumers looking for low-priced items, bargain, cheap, low price. I mean, there's a lot of different potential searches, but we're looking for when the consumer begins to alter their spending habits based on future inflation expectations, because they already expect future inflation, but as of today, all those searches are at 5-year lows. So the consumer may talk an inflation book, but they're not acting like they're worried about inflation. That's an important tipping point. The other one we're looking at is trends in mobility and mobility around the US, particularly around major cities, because the biggest problem with unemployment in this country right now is urban areas. Unemployment in New York, LA, and Chicago is all 9 to 10% today, about double what it is the national average. And that's a problem because it's very sticky. I work in Midtown Manhattan. I'm here every day. I see it. And the unemployment data is not representative of what's going on. It's an urban-based unemployment problem. So I look at things like literally how many people get on the subway in New York every day. It's still down 50% from 2 years ago. And the unemployment data is not going to come down until the urban unemployment data comes down. And that's a long haul. And in addition to that, we're looking at things like suburbanization and how people have moved out of urban areas in the last 12 months. And that's going to affect consumer spending. It already has in terms of things like buying homes and, how Home Depot is done. But that's going to either continue or begin to unravel once we're watching those population shifts. But it's, our work tends to focus on, what are the macro issues? And the macro issues are inflation and unemployment. And they're not broadly understood, I think, accurately when you look at the data, because consumers might talk inflation, but they're not looking for cheap items, and people are still not coming to cities, so unemployment remains very, very high.
Thanks, Matt. What are you focused on?
Yeah, from my perspective, I think that the market has changed, as I mentioned before, over the past 18 months, where I'm not focusing so much on sectors. I'm focusing on trying to identify emerging concepts and themes. And I think the market has become very, very sensitive to this. If we go back to the spring of last year with COVID and then the rise of COVID as a theme rippled down through different sectors in the economy in very different ways. Obviously, the travel hospitality sectors got hit very, very hard. And then after initial drop across the market, then we started seeing this differentiation where you had stocks like Amazon or Home Depot, Lowe's. All of a sudden, these stocks started rallying and rallied very, very strongly throughout the pandemic. Then you had all the talk of vaccines and what that would mean for the recovery of the economy. So for me, I think what's important is to be able to use data to identify emerging concepts and themes, and the market will react very, very quickly to these. And this is happening much, much quicker, I'd argue, than it has in the past. Kind of to Nick's comment, I think, again, on this theme approach, you've got electromobility, you've got the greenification of industry that's being supported by direct investment, by tax preferences. In the US, you have the massive infrastructure funding, the fiscal stimulus that is starting to work its way through the economy. How will that impact different sectors? So I think it's, from my perspective, it's as much a sector as a concept and theme driven market as it is pure sectors.
And Sean, what trends are you looking out for?
Yeah, I think to Matt's point, top down thematically, I believe that really Olga hit it right on the head in terms of retail and what the retail landscape is really doing in the space. They've proven the ability to move the markets in a significant way. So we've seen a real uptick in interest in terms of like what are the what are the Reddit subs really talking about in terms of where they're headed next. When I believe it was when Matt and Chris were talking about the timing element, right, and the time frame and the tenor of data really shortening into this minutes and seconds kind of scenario, we've seen an uptick there. On the option side, we've seen a large interest where we used to see people who wanted to know what was happening from the institutional landscape. Now they're just looking at saying, okay, well, cross asset, how are we going to be looking at options data in order to use that data to predict equity price movements or things of that nature, and then being able to use shorter term data in order to be able to effectuate that. So we have a few products on our hand, and I'm not going to speak our book, that are able to do that across some of the various exchanges that we own and operate. So that's really what we're seeing in terms of moving into next year, moving into the end of this year, and the uptick on the option side has really been amazing, and that's really my focus. So yeah, it's been great.
Excellent. I think we're going to wrap the formal kind of prepared questions there, and like I said, get to Q&A. Thanks again, everyone, for your remarks. Let's see, I'm just going to open the Q&A here, and our first question comes from Ivy Schmerkin. She's at FlexTrade. She wants to know, in terms of alternative data sets, how are you viewing or using ESG data? Are you seeing increased demand for ESG data on part of the buy side? Traditionally, we know that there's been a shortage of reliable data and standard ESG metrics. So is there anyone that's been looking into ESG data? That might be a no.
I could kick off and just say, I think there's, or did Barry want to answer this one, or somebody else can?
I think it's you, Chris.
Okay.
Are you seeing increased demand? The main question is, like, from your clients, are you seeing increased demand for ESG data? Specifically, she wants to know on the part of the buy side.
I think the buy side ESG craze was like 3-4 years ago. There were a couple of dozen firms out there, and while I was at my prior shops, we spit through all of them. And same thing like a lot of other industries, there's a couple of providers that have quality data. So that's really number one, but then what do you do with that information? So there's the slower moving, if I want to invest in a more sustainable company or companies with more diverse boards, do they tend to outperform over time? There's so many other elements, you cannot draw a direct correlation to it. And people love to do it all the time, especially, you know, in the media and articles that, you know, companies with more, you know, flexible or friendly workplaces tend to outperform over time. But those companies could tend to be, you know, more older. They could be based in a different population. They could be hiring a different amount of people. There's no way to directly correlate it. I think it's important to have it. So if you're creating an index that you don't want to invest in any firm that produces weapons, right? That's like the typical ESG thing is, I want to screen out tobacco and firearms, for example. Now you want to screen out companies who are polluting the environment, or who don't have some ESG footprint in their footnotes or something like that. And then you can argue, okay, well, now that the companies know that, they put a standard block of ESG that they're spending $1 billion on cleaning up the environment, and then you can argue, are they really doing that? So I think for ESG for buy side, it's become a little bit less prevalent, but I think for maybe some of these asset managers and these truly ESG sustainable funds, it's still, they're experiencing that boom now. They're kind of obsessing over the data that the buy side really picked through 3-4 years ago.
Yeah, I'll back that up
I would,
for sure, Chris. Sorry, go ahead, Matt.
Sorry, I was going to say to add to Chris's comment. I think my experience speaking with some of my first clients in the long only space is they're very much on the steep part of the curve, and that's being driven by their investor demands. There is increasing demand for, you know, let's just call it ESG compliant funds or ESG driven funds. I don't think this is a fad or something that's going to go away. I think there's been a lot of talk about using ESG for alpha, and I think that that is going away. I don't think there is a lot of alpha in ESG. There may be a little bit, but I think what's more important is that investors will demand a certain, you know, and again, it's kind of a very vague term now, but a certain level of ESG, a certain ESG score. I don't think it's going to be too long before ESG related factors are going to be a big factor in a company's cost of capital. So, and equally, there'll be many funds that investors won't touch unless they have a certain ESG profile. And the buy side, the long only side is responding to that. So there's still a lot of work. Obviously, the data ecosystem around ESG is very, very fragmented. There's a lot of disagreement. There's no final arbiter of what is what. The market is figuring that out. There's a growing ecosystem of firms that are meeting this new demand. But it's something that I firmly believe will not go away. It'll only increase in importance over the coming years.
Sean, did you want to add to that?
Yeah, absolutely. I mean, so ESG, I think, really started in terms of like looking for firms and companies that were very economically friendly, and/or the carbon credit craze really started in like 2007, right before the global financial crisis, and then everything kind of started to slow down a little bit, and then started to pick up pace again. And to Chris's point, it certainly did have a boom of activity within the last 3 or 4 years, but I think we've been seeing the ESG, or at least the demand for ESG type data, start to wane a bit. As with any data set, it'll begin to become commoditized over time, right? So as access to these data starts, as the demand starts to come in, the supply starts to come in, and then all of a sudden the demand will start to wane as there's just an influx of supply. So I think we're definitely starting to see that wane, and we're starting to move into what is going to be the next trend. Right. And then the next trend, for at least right now, or the hottest thing going right now, would be retail and the interest in retail. Yeah, you could even start to talk about meme stocks and things of that nature, or what effect the crypto market has on the equity markets. I mean, there's a lot going on that's a relatively new, that we're starting to get a little bit more data interest in. Right. And so like what is decentralized finance having to do with the centralized finance developments? And how are products going to be innovated in the market, either from the data side, or from the trading side, or from the market side, and just in general, right? So like I think again, ESG down a little bit, but new stuff is coming out on a daily basis.
Great, thanks for those comments.
Well, your note on crypto is interesting, Sean, real quick. I mean, that's really what tanked, part of what tanked the last crypto market from 60 down to 30 was Elon Musk made his comment. Kevin O'Leary, if you follow him, had made that comment 3-4 months ago that he was investing in sustainable Bitcoin miners and things like that. And then once Elon got into it, and then once China, to someone else's point on the panel, is shutting off data sets, they're shutting off the mines. So maybe ESG has more, like the hockey stick will be more towards the crypto craze. They might have to have these disclosures now. How are you mining this? Where are you getting your energy? Are you destroying the small town nearby type of metrics?
Chris, you lead me right into the next question we got. I think this was directed towards comments that Nick made earlier. You mentioned one example of how China has made it more difficult to garner data insights. How does the buy side deal with this closed door trend?
Yeah, the bottom line is it is obviously difficult. I mean, unless you're talking about satellites or about things like air quality that have to be disclosed and are disclosed, it is very hard. I mean, satellites was something that I think was popular 4 or 5 years ago. I'm not sure how popular it still is today. Maybe other panelists can certainly speak to that. But it is increasingly difficult. We have a lot of problems with it. And the only 2 hacks we had were TomTom data and air quality. TomTom went away, and now it's really just air quality. But thankfully, the air quality indexes are available back to 2018, so we can do a pre-post COVID comp and see how air quality is shaping up. It also allows us to look at some things like what the flooding has done to some regions of the country in terms of industrial output. So it is a very helpful real-time indicator, but it's obviously imperfect. But I don't have a lot of great answers right now aside from air quality. Perhaps the other panelists do.
Anyone else want to say anything about China?
I think with China, you have to go into it with eyes wide open. I'll give you an example. 5 years ago or so, we looked at Weibo data. That's China's Twitter. And with quants, you need a very consistent signal. You need a consistent history. We looked at the history, and this summer, China shut it off. That's just the risk that you take with these data sets. And then you can start to look at things. Okay, I'll look at electricity consumption. And then the running joke was that, China just left all the lights on in all the warehouses, right? Or they were flaring off their, running their coal plants 24 hours a day, even if there's nothing in there. So the fact that we were looking at it, they were kind of, in some cases, gaming the system back. But that's just a risk you take in those markets. And I think you can still go back to things like transaction data, event-based data. You can look at things like earnings transcripts. I mean, that's solid information, right? That gets released by the company. I haven't heard of anything where China is blocking us from reading an earnings transcript, right? So you have to go really back to the building blocks in these firms and just understand that that data might not be there tomorrow.
We have time for one more question here. How do you see the current climate for single equity investing since the pandemic flight to ETFs and or passive investments? Do you see big variations on this climate in North America versus non-North America? Anyone want to take that one?
I'll just take a first stab at it. I was looking, we did a piece in data last night and just showed up a simple chart, which is Robinhood's chart from their S1 showing new customer acquisition since 2013. And the net of it is there's 12 million new customers at Robinhood over the past 12 months. And they've got 18 million active accounts right now. And when you look at back when the Robinhood data was available, you saw that most of the key holdings and transactions were in single stocks. So I think it speaks to what the other panelists have been talking about, super important, which is as much as ETF flows are kind of where the big money goes and where the older money goes, the younger money and a lot of it in fragmented trades goes to single stocks. So I'd say, and unlike the last 20 years, I mean, the peak in US stock listings was in 1998, I think at 7,000 plus. It fell down to, I think, something like 3,500 2 years ago. So basically being cut in half. But between SPACs and de-SPACs, we've got, and IPOs, we have 300, 400, 500 new companies in the US, which is a dramatic reversal from the past 20 years. You know, the Wilshire 5000 hasn't had 5,000 stocks in it for the better part of a decade, I think. It's going to have 5,000 stocks again. So there is more opportunity to invest in single stocks. There's more single stocks with news stories to buy. And there's the retail flow that people have talked about, which is, again, is super important to understanding, you know, how retail is actually behaving around those stocks. So I'd say ETFs are a powerful force, indexing is a powerful force, but we've had an amazing resurgence in listings and in retail investor interest, which you have to go back to like the 1980s, honestly, to find. And we have it again now, which is amazing.
Yeah, and Nick, you really bring up a great point. You know, as I've been in this industry, I've seen the rise of the ETF, and we've seen the rise of the index options, right? And then over the last couple of years, and specifically over the last 18 months, you know, with the SPAC invasion into the U.S. landscape, and then, you know, retail traders beginning to focus more into the single stock space, specifically in the options space. I know that it was an equity forward question, but I've seen a tremendous uptick in the amount of single stock options trading relative to ETF and index. We actually had index on a year where the options industry increased 35% volume year over year. We actually saw index options trade lower based on the interest being almost solely in the single stock arena, right? So there are certainly a lot of interest there. And then, you know, to speak globally in terms of like North American versus a global really mindset, I think that the trading mindsets are always a bit different between North America and Asia, probably having a little bit more of a higher turnover. And then retail product in Europe and other parts in the Middle East, you know, being a lot more structured product centered, right? And so maybe not as much single name, you know, purchases elsewhere than in the States and Asia.
Can I also comment quickly on ETFs? So ETFs, they've been not only a way to get exposure to like index tracking, passive investment, but also mostly as a tool to lower the cost of trading or cost of getting exposure to a certain like basket of names or an index. And so now the more and more ETFs become popular that are concentrated like thematic ETFs and actively traded ETFs. So it doesn't necessarily mean passive anymore.
Thank you so much for everyone's comments, and we're going to wrap it there. But again, thank you. We really appreciate you all taking the time to join us today. I think that was a really great conversation that the listeners are going to get a lot of value out of. To everyone that's listening, thanks for joining us. We do encourage you to book one-on-ones with any of our panelists for private consultations later this afternoon. We're going to be sending around an email with a link to how you can book with them. And I think there's variability amongst when they're open. So take a look at that email, and thanks again for joining us. We hope to see you at some of the one-on-ones later today.